Welcome back to Primary Source China Investment. This week we're on show G7, and we wanted to talk a little bit about the size, scale, and some of the reasons for the recent uptick in China. I mean, there's plenty of news about all of the stimulus, but we're going to go a little bit deeper today. And the first thing we wanted to talk about is US ETFs, and we just wanted to give some perspective on size. Total assets under management, China ETFs and funds is about 20 billion, which was about 15.5 billion 10 days ago. To put that into perspective, total AUM for Japan ETFs is 38 billion. So David Tepper famously said, buy everything, two-fisted, manages $17 billion and has publicly, stated that China is the best trade right now. He can obviously move the market if he wanted to, just with his fund. I'm not saying that he's doing that, but just because the size of the US ETF market is small, which lead me to a hypothesis that, well, maybe China is just a crowded trade. A lot of people rush in, a lot of people rush out. That could certainly be the case for the names that are traded in the US and for the US ETFs. But overall, Shenzhen and Shanghai is a sea of liquidity and size. Just to give some perspective, Shanghai and Shenzhen market cap is about 11 trillion US dollars. So it would be impossible for a fund to move the entire market. So that does mean that everybody is buying. Pengguo, I know you have some thoughts here, so why don't you jump in?
The main reason is China security market has different characteristics compared with the U.S. market. So U.S. market is relatively stable, more consistent, and but in the China market, it's show much more irrational activities in the
Irrational.
irrational, yeah.
Yeah.
So so it's a little bit hard to capture those kind of the activity, but that's really need experience and spend the time to consistently track this market.
Yeah, one of the things that I was looking at is a recent chart of the A shares versus the Hong Kong/US listed names. And what you see is that A shares have shown a little bit less volatility and better returns. Historically, both of these A shares and H shares have given you a lot of volatility and low returns. If you want to look at information ratio, Sharpe ratio, both have been, bad trades. One interesting thing to note is this week, the A share market was closed. So you had this situation where you had ETFs trading based on some A shares. You also had Hong Kong, which was open. Hong Kong accelerated another 11% this week, even while the Shanghai market was closed. And Shenzhen markets were closed. So there's a lot of still more speculative trading going on. What do you see, Pengguo?
Yeah, speculation is everywhere. So generally speaking, if you see the Sharpe ratio for the major index in the A-share market and the H-share market, A-share is better. The A-share has a much larger investors and provide a much higher liquidity. H-share is affected by the foreign investors, which also affected by the international politicals. But overall, in China, I think if you follow our program, you will know. Firstly, we already predict this is the bottom area. Not just one day; it's just the area. And secondly, we already mentioned the share market. If the bounce back, it will be very quick, but it's still much quicker than we expected. So that really means you need the help for the professionally track and monitor those market.
Yeah, the other thing I was reading a lot about is it seems like the same names keep coming up, particularly for Western investors, right? The names of Pinduoduo, the names of Alibaba, Jingdong, Tencent, these names keep coming up. And a lot of that is captured in KWEB, MCHI, a lot of the so-called the largest China ETFs. And if you look at this K-Web, and I'm not beating up the people at Crane Shares, they're good guys and good people, but if you look at the performance, that's where the problem that I have. If you track the A share, the CSI 300 ASHR versus KWEB, this so-called China tech trade, you see over the past 3 years, you have double the volatility with the same return. There's no polite way to say this. That's a horrible trade-off. So you're getting a lot of volatility and not getting any more return. I think that's the most interesting takeaway recently. And, you know, if you're a little bit of a conspiracy theorist, you could say David Tepper or anybody else with a deep pocket, if they wanted to drive up some of these names or some of these ETFs, you know, a la Hello Kitty and GameStop, they could certainly do that.
Yeah, and the Asia market recently they added one more index called the A500.
Yeah.
That's really we are keeping saying is it's like the US S&P 500. So that really means in China right now is cover all the industry area, is a number one manufacturing country in the world. So that's the economy. It's much stronger than any other countries. So that doesn't reflect to the security market. This round
that's a great point. That's a great point. You have a 17 or 18 trillion dollar economy, and it's not really reflected in the stock market. That's been the case for a long time.
Yeah, and number two is compared to the security market size, and right now China probably 80 trillion. Compared to overall the GDP, China is much smaller than the United States.
Yeah.
So if you reach to the US level, it will at least double the return or double the size to the current market. Number three is current PE ratio is probably around 14.7. And if in the bull market, most of the time the PE ratio can reach the 30. So that means it still have the potential to increase the 100%. And also from the technical analysis, especially from the according to the monthly, quarterly, and the yearly chart, it's easy to see if this round is pretty big. So if we reach like the 100%, it should not be the difficult. Maybe take 1 year, 2 years to reach that high. So let's see.
Right. The point about the size of the capital market, China's size is about 11 trillion, Shanghai and Shenzhen combined. The savings rate is the savings amount, not rate, is 19 trillion. Whereas in the US, the stock market's 55 trillion, something like that, and savings is about 1 trillion. So Americans, A, they don't have a lot of savings, and B, any savings that they do, they tend to put it in the stock market or the bond market. Whereas in China, you still have a lot of savings. And if any of those savings, you know, convert into the equity market, you're going to have a much higher level than we're currently seeing. The one thing I wanted to end on is, you know, we keep hearing about these names, Pinduoduo, Alibaba, Jingdong. I keep talking about the non-sexy names, which is China Merchants Bank, Zijin Mining, Ping An. If you look at those stocks, they have performed just as well. And to me, they don't have the headline risk as some of these other names. So we're going to be tracking those and obviously the high-flying names and the more popular names. But we're going to leave it there for show G7. Thanks for tuning in, and we'll see you next week.
Thank you.